On July 4th, 2025, the president signed into the law the largest tax bill in American history.
The motion is adopted.
And it's already in full effect. This isn't just politics. This is your money on the line. Congress just passed a law that could put tens of thousands of dollars back into your businesses every single year if you know how to use it. Most business owners, they will miss out. No plan, no strategy, no results. But you're not most business owners. You are here because you are ready to win, not give away your hard-earned money. So stick with me till the end of this video, where I'm going to be breaking down 20 smart, real-life strategies this new law unlocks to boost your cash flow, slash your taxes, and help you finally keep more of what you've been working so hard to earn. So let's turn this law into the biggest financial advantage yet. I'm Ella Rivkin, tax strategist, 10x business coach, and a real estate investor. And for over 26 years, I have helped business owners like you uncover hidden money, pay less in taxes, and build real wealth without working more or sacrificing the life you want. So grab a pen, because today I'm gonna share with you the same strategies that my clients use to stay ahead of the game and grow much faster. And then you can start using them immediately and keep more of what belongs to you. The first benefit is the lower tax rates. They're gonna be staying the same. So if you remember those lower income tax rates that we received in 2017, well, they were about to expire this year, 2025. But now with this big, beautiful bill, they will be extended up until the year 2034. So let me just share with you what it means. So before, the tax rates were 10%, 15%. So this is where the main change is. It used to be 15%, now it's 25%. Before it used to be 25%, now it's actually 24%. And before it was 28%, 33%, 35%, and even as high as 39.6%. So today it's 12%, 22%, 24%, 32%, 35%, and the highest is the 37%. So meaning that you as the business owner, as the taxpayer, will be keeping more money in your pockets, and that means that will be bigger cash flow. So let me just share with you a real example. So let's say if you earn $200,000 a year. So with the old tax rate, that means that you would be bumped up to the higher tax bracket that will cost you between $8,000 to $12,000 to pay more every single year in taxes. But this year, with these extensions and then going on up until 2034, that means that you would be able to pay less taxes, meaning that you will keep more money in your businesses, in your family, in your pockets, and you can potentially reinvest them. So what it means? Lower tax rate equal more cash for you to save, invest, and grow your business. The second benefit is the 20% pass-through deduction. This is one of my favorite ones. So what actually happened? So this is something that we received first time in 2017 with the first Trump's Tax Jobs Act. So now it's been extended because this year it was supposed to expire, but thanks to this big, beautiful bill, this has been extended up until the year 2034. Yes, so now you as the business owners, you can take advantage of this beautiful 20% pass-through deduction. So we never had this before. This is the first time that was introduced to us in 2017, and we get to take advantage of this up until the year 2034. What it means, if you own an LLC, S corporation, partnership, or if you're freelancer, sole proprietor, then you can take advantage of the 20% deduction for the qualified business income. It means that, let's say, if you have a profit of $200,000, so now out of that, the 20%, the qualified business deduction, is a deduction that you are allowed to deduct, which is $40,000 of $200,000. Next, what it means, let's say if you are in a 24% tax bracket, so out of this $40,000 that you can now deduct, you're actually saving $9,600 every single year. So this $9,600 you're actually putting back into your pockets. This is one of the amazing tax savings, and any business owners that is an LLC, S Corp, or partner can take advantage of that. So if you are still on C corporation and you're not taking advantage of this qualified business deduction, that make sure that you do, because this is one of the fastest way that you can boost your cash, increase your cash. And this one rule alone can cover your rent or help you to hire some more people in your business. So the third benefit is the full bonus depreciation deduction. So what actually changed? Now you can still write off the full cost of the big stuff like equipment, computers, vehicles, softwares in the first year you buy it. So this is called bonus depreciation. So let me just share with you an example. Let's say if you purchased a truck for your business, you're in a transportation business, and the truck costed $80,000. So instead of writing it all slow over 5 years, because typically this is what we do, we depreciate over the 5-year period. So now you can take advantage of this 100% bonus depreciation and then deduct the whole 80,000 in a whole year. So now what does it mean for you in the real money? So let's say if you are in a 24% tax bracket. So now if we take this $80,000 times 24%, that means that you are saving $19,200 back in your pockets right away. So here's another beautiful thing. This is a bonus that I would like to share with you. So now let's say if you don't have money to purchase this vehicle for $80,000. So let's say if you finance it, you can still take advantage of this whole deduction. So it doesn't matter even if you didn't buy this, if you just finance it, and let's say if you only put a down payment of 20% of like $16,000, you can still take advantage of deducting the whole $80,000. And here's another beautiful thing. So let's say if you're in a transportation business and your business generates money from this owning this vehicle. So the more vehicles you put on the road, the more money you will be generating. So now by saving this $19,200 in taxes, you can buy another vehicle, because you don't need $80,000 to purchase the vehicle. You can put this $19,200 as a down payment, purchase another vehicle through the financing, and then again take the full deduction, and then again save money, and you can keep going and going. And this is one of actually the ways how you can boost your gross revenue, boost your cash flow, and scale your business much faster. Why this benefit matters? Because this frees up your cash flow to reinvest and grow much faster. The fourth benefit is Section 179 expensing limit. It's double. So what changed? It's Section 179. It lets you write off equipment, furniture, and the software. With this new bill, the limit rose to $2.5 million per year. So what it means, if you are buying a lot of equipment, and if you're gonna buy in one single year a total of $2.5 million, so that means that up to that amount, you can take advantage of this Section 179 deduction. So let me give you an example what it means for you in real money. So let's say you expanding your office and you spend $150 on desk, chairs, computers, softwares, and now you want to write off all of this deduction. So instead of spreading this out for 5 years or 3 years, you can actually take advantage and deduct the whole $150,000 in one single year. So now what it means, let's say if you are in a 30% tax bracket, so 30% out of the $150,000 that you will be paying out, that means that you will be actually saving $45,000 in taxes right away. So why does this matter for you as the business owner? That means that you can take this $45,000 and maybe buy another big purchase of an equipment and put it back into your business. So big purchases no longer drain your cash flow. They actually protect your cash flow and allow you to grow and scale your business much faster. So the fifth benefit of this big, beautiful bill act is the higher standard deductions. So what changed? The bigger standard deductions, they will be staying the same. So this means that more people skipping itemizing deductions. So in order for you to take an itemized deduction, then you will need to make sure that you have all the receipts and all the invoices, and not so many people can even take advantage of the itemized deductions if they don't own a house, they don't pay interest, real estate taxes. So with the bigger standard deductions, that means that even if you don't take the itemized deduction, then you can still take advantage of this standard deduction. So let's say if you are married filing jointly, then you are allowed to deduct $31,500 in one single year without any kind of receipts. So now What does this mean for you? So let's say if you are in a 24% tax bracket. So out of the $31,500 that you're deducting, that means that you're putting back in real money $7,560. So here's another bonus deduction for the senior 65 plus under this one big beautiful bill. So this is an extra deduction that is given up until year 2028. So the taxpayers that are 65 years plus, they can claim an extra $6,000 in addition to the standard deductions plus to the $1,600 that we just spoke about. So what does it mean? We take the same example, married couples, they take standard deductions, which is the base $31,500 plus the $1,600 for each person, plus $6,000 in addition for each person. So then if we add all of this up, it comes out to $46,700 in tax deduction. So now let's say if you are in a 24% tax bracket, so that means that you will be saving $11,208 in taxes. So this is one of the greatest way to take advantage of all these deductions, to plan smart before the year ends, so then you can boost and increase your cash flow. And here's another thing, like, why is this important? It's always important to strategize before the end of the tax year, so then this way you can see how you can maximize the tax deductions. So let's say in this example, which I just shared with you, if you have your family members working with you like I do, I have my mom working with me, my brother, my kids, and everyone. My mom is 75 years old. So now knowing that this new big beautiful bill gives us all these extra benefits, so then she can start potentially getting a bigger salary, which is a great advantage for her, and then at the same time for me, because I'm going to be saving all this money on taxes. So that's why it's very important to take advantage of all of these tax strategies that I'm sharing with you before the end of the year. Okay, so now let's move to the sixth benefit, SALT cap increase. So what is the SALT cap increase, and what is SALT to begin with? So for those of you that live in high pay state and local taxes, like if you live in New York, I used to live in New York, and we pay crazy taxes, and we pay New York state taxes plus the city taxes. Also, for those of you that live in California, you're gonna love this one. So what actually happened in 2017 with the new Trump Job Act, this was implemented. So before we were allowed to deduct all the state taxes we pay, city taxes we pay, real estate taxes we pay. But then when in 2017 the new bill was implemented, so they actually took this away, and they said that the maximum we can deduct is $10,000. So with this new big beautiful bill, it was raised from $10,000 to $40,000 through year 2029. So let me just explain to you and show you example in the real numbers and what does it mean for you. So let's say if you live in New York City, and let's say you paid $30,000 in New York state income taxes, and then also you paid $15,000 in New York City taxes. So that's a total of $45,000. So with the old rule, with the old law, you were only able to deduct the total of $10,000. This is what it was kept in. So now, because of this big beautiful bill, you can actually deduct out of the $45,000 that you paid, you can deduct $40,000. So now, what does it mean for you? Let's say if you are in a 32% tax bracket, so that means that you're going to be putting extra $12,800 in tax savings back into your pockets. So why does this matter? It matters for the high earners, those that live in New York, New Jersey, Connecticut, Pennsylvania, and still have their businesses in New York, and also those that live in California. Now they can actually have more cash available to them. The seventh benefit is the 21% corporate tax rate. It's going to be staying the same. So what actually changed? The corporate tax rate stays at the flat of 21%. So before the 2017 cuts, it was 35%. So with the old law, if you would have paid 35% taxes, so let's say if you're a C corporation that makes $500,000 in profit. So if this were not extended, then with the 35% tax rate, you would owe $175,000 in taxes. But luckily, with this big beautiful bill, we got an extension and we are paying 21% taxes. So that means that you're only going to be paying $105,000 in taxes. So that's actually $70,000 saving in taxes. So why it matters? more profits to reinvest, pay dividends, or expand your business. The eighth benefit is the meals and entertainment deduction. So let's talk about this one. So what's being added in this bill is starting 2026. So that's not going to be retroactive as of this year. So it's starting January 1st, 2026. So let's say if you are an employer and then you provide meals for your employees, then you can actually deduct 100% for all these meals. So meals provided by employers for the employees' convenience, such as break room meals, on-site catering food, cafeteria, meals at company retreats, it will be 100% deductible. So what does it mean for you as the business owner? It means now you can continue deducting the meals, which is only 50% deductible. So let's say if you're taking your clients for the business meetings and these are clients related meals that you're paying for, then you do need to keep the very strict documentation, and then you can deduct 50% out of it. But starting 2026, if you are providing meals for your employees' convenience, then you can actually deduct 100% of this cost of these meals. What it means for you? Then you can provide some extra benefits for your employees and at the same time take advantage of all these deductions. The ninth benefit is the family income shifting. So what actually changed? You can still legally pay your families for the real work in your business. And this is one of the deductions I love as well. I mean, I love all the deductions, but this one I love as well. So let me just give you an example. Let's say if you hire your child, let's say your child is 18 years old and they're helping you in the business and they're doing administrative work or social media, and you're paying them $15,750 a year. What it means is that they don't have to pay any federal taxes on this $15,750. And if you're living in a state like I live right now in Florida or any state that doesn't have state taxes, that means that they don't even need to pay state taxes as well. So why this is a good idea to do this? Because, well, you're shifting the income out of the higher bracket into the lower bracket. So let's say if you are in a 32% tax bracket, and then by paying your children this $15,750, that means that you will be saving $5,040 in a single year. And now let's say if you have two kids, then it's going to be $10,080 in the single year. So why does it matter? Well, first, you're teaching kids responsibility to keep money in the family, and you pay lower taxes or possibly not even any taxes at all. The 10th benefit is the opportunity zones. Opportunity zones are here to stay, and they've been extended under the new tax law. If you sell an investment like stocks, crypto, or real estate and realize a capital gain, you can roll that profit into an opportunity zone fund. So by doing this, you can defer taxes on the original gain, potentially eliminate taxes on the new opportunity growth inside the opportunity zone investment if it's been held enough, and typically it should be about 10 years. So let me just give you an example how it would work. Let's say if you sell a stock and you earn $200,000 capital gain. So instead of paying taxes this year, you can reinvest the gain into an opportunity zone fund. You pay no tax today. You may pay zero tax on the future gains from the opportunity zone investments if you keep them after 10 years. So then why does it matter? Well, this is one of the most powerful tax strategies for investors, especially in the real estate. Defer capital gains now, compound returns tax-free, possibly eliminate tax on your opportunity zone investment profits entirely. So if you stride opportunity zones are legal pathway for long-term wealth with zero capital gain tax. And here's another kicker. It's a perfect for anyone selling assets and wanting to reposition into tax advantage real estate. The 11th benefit is the estate and gift tax exemptions. So what changed? You can still pass more of your wealth to your family tax-free. Yes, listen, unfortunately, even if we die, we still have to pay taxes, but we do have advantage of these gift taxes. So throughout your whole life, for each person, the gift tax is the total of 13.99 million. So each person gets about 13.99 million. So a couple can actually transfer about 27.98 million without estate tax. So that means that they wouldn't have to pay any taxes if they transferred that to their children or someone in their family. So this means that individual can transfer assets up to this amount during their lifetime or at a death without incurring federal gift or estate taxes. So why it matters? Protect family business and create bigger legacy. The 12th benefit is the Affordable Care Act. Taxes are on hold. So what changed? No new hidden Obamacare taxes that will be added back. Specifically, no surprise on the 3.8 net investment income tax on a business owner's passive income or capital gains. Under the old proposal, there was a talk of expanding this 3.8 tax to hit more income sources, especially for the S corporation owners, real estate investors, and high earners. So this luckily didn't happen. The new law keeps these things clear and clean, and we're not paying any more taxes on that. So what is the 3.8%? The net investment income tax. The net investment income tax is a 3.8% surtax that applies to certain types of income, including dividends, interest, capital gains, rental income, and business income from passive ownership like silent partners. So if this bill would have been expanded, then this tax would have hit actually millions of business owners who take dividends or real estate investors who generate passive cash flow. So why this benefit matters? With the new hidden surtax, you keep more of your investments and passive income. You avoid unexpected tax hits during filing season. You can actually plan proactively and confidently, especially if you rely on these multiple income streams. So this is a huge win for the business owners, real estate investors, and high income earners. And a reminder that the right structure still matters. The 13th benefit, higher retirement contribution limits. So the 2025 retirement contribution limits were increased. And again, that's why it's very important to plan everything before the end of the year, because by taking advantage of all these limits, you can take massive deductions. This is one of the strategies that I absolutely love, because this allows you not only to take massive deduction, but then at the same time, whatever you earned in these funds, by deferring this income, it becomes in a way tax-free, because you're deferring all the taxes that you have to be paying, and this allows you to increase your cash flow much faster and increase your wealth much faster. So what do I mean? And let me give you an example. So employee elective deferral like 401k or solo 401k is $23,500 limit for the year 2025. So if you are between the age of 50-59, you can do a catch-up contribution, which is $7,500. So now you are able to deduct $23,500 plus $7,500, which is total of $31,000. However, if you are the ages between 60 to 63, now you can deduct a super catch-up contribution of $11,250. So that's a total of $34,750. Give you an example. If you are in a 24% tax bracket, what it means for you? It means $8,340 in total tax savings. So now let's take this even further. Let's say if you take advantage of the employer profit sharing, which allows you to deduct up to the 25% of the total compensation, which is kept at $350,000. So if you are under age 50, you can potentially deduct as much as $70,000. However, if you are between age 50 to 59, you can now deduct $77,500. And if you are between the age of 60 to 63, then you can deduct even more, which is $81,250. So now let's say if you are in a 24% tax bracket, that means $19,500 in total tax savings. So you see, this is why, again, it's very crucial that you take advantage of all the tax plannings before the end of the year, so you can boost your cash flow, increase that cash, and reinvest it back into the business. So why does this benefit matter? Because you can shield tens of thousands of dollars from taxes every single year. Smart use of the catch-up limits help those over 50 or approaching retirement. Solo 401k often outspaces SEP for higher earners, especially with super catch-up contributions. The bottom line is you want to pay your future self, not the IRS, and take advantage of all the benefits that are out there. The 14th benefit is the 1031 exchange. It's still on the table and it's still out there. So this is one of my favorite as well, especially for those of you that are business owners and real estate investors. The 1031 exchange remains fully intact under the new 2025 tax law, and it's a massive win for each real estate investor. So what does it mean for you and what can you still do? Sell investment property, defer capital gain taxes, reinvest the entire profit into another like-kind exchange property. So this means no cap, no limits, no surprises. Without the 1031 exchange, you will be paying more in taxes. So let's say you sell a rental property and you make $1 million in profit. If not for the 1031 exchange, then you would be paying taxes on the capital gain. Federal plus the state plus the net income tax, approximately 30%. You pay $300,000 in taxes on that $1 million profit. So that means for you that you only will be left with $700,000 back on your account and be able to reinvest. So now let me give you another example if you were to do a 1031 exchange. With the 1031 exchange, you actually defer the tax. So the same scenario, you sell the property and you have $1 million in profit. But instead of actually paying taxes now, what you're doing is you're doing the 1031 exchange and you're reinvesting and buying another property. So what it means for you, now it means that you're gonna defer the entire $300,000 that you were supposed to pay in taxes. So now, instead of actually having $700,000 like in prior example, you actually get to keep the whole $1 million in profit and reinvest it back into the new deal. So what it means now, it means that you can earn more cash flow, build more equity, and enjoy greater appreciation, all without touching your own savings or reducing your buying power. And here's another beautiful thing. Over the time, the more properties equal more rental income, more appreciation equal higher net worth. This is what wealthy people do. You just keep repeating and doing this 1031 exchange. At some point, when you decide to sell the new property, you sell it, reinvest the money in 1031 exchange into buying new property, and then this is how you keep growing your wealth and making more money. So repeat 1031 exchange equals tax deferred continues until you sell outside of the strategy or until you pass away. But then at that point, who cares at this point? The bottom line is 1031 exchange equal leverage plus growth plus tax strategy. So this is how investors build real wealth. And the wealthy people, they've been taking advantage of this for generations and generations in America. This is one of the biggest and the beautiful tax savings and opportunities for the real estate investors in the US to take advantage of without actually paying the silent partner, which is the IRS. The 15th benefit is favorable long-term capital gains. So what changed? If you hold an investment for over a year, then you are still able to pay 15 to 20% capital gain taxes instead of 30 to 35% income tax. So let me give you an example. If you sell a stock for $100,000 gain, then you pay $15,000 in taxes, not $35,000. So you keep $20,000 more. So why it matters? Smart timing equal real savings. So now we have covered 15 the key benefits, and right now I would like to share with you the 5 critical new pieces. So this would be the 16th benefit. The 16th benefit is the overtime and tips exemption. So under the new 2025 tax law, overtime pay and tips are now tax-free at the federal level through 2028. So this means workers in industry like hospitality, retail, and healthcare can now earn extra without being penalized by higher taxes. So for example, a restaurant server earns $10,000 in tips and $5,000 in overpay. So that means that under the new law, none of this $15,000 is subject to federal income tax, and they get to keep the whole 100% of it. So why does this matter? This change puts more money directly into workers' pockets. It's great news for the hourly and tipped workers who depend on extra hours and tips to make ends meet. It could potentially boost motivation and productivity. So now more hours equal more take-home pay. And then for the employers, for those of you that are business owners, you may also find it easier to fill shifts and retain talent. So this is not just a tax break, it's a financial lifeline for millions of Americans working extra hard. The 17th benefit is the auto loan interest deduction. Under the new 2025 tax law, you can now deduct interest on personal auto loans, even if the vehicle is not used for the business. So there is a cap, likely tied to income or a loan size, but for the first time in years, regular customers can benefit from the deduction previously reserved for business owners. So let me share with you an example. So let's say if you pay $4,000 in interest on the car for the year. So let's say if you pay $4,000 in interest on your car loan this year, at the 24% tax bracket, that deduction could save you $960 in taxes. So this is real money back just for driving the car you already own and pay for. So why it matters? Even if your car isn't 100% for business, you can now deduct personal auto loan interest and a new opportunity to reduce your taxes. For entrepreneurs using personal vehicles to meet clients or run errands, this means real savings without complex mileage logs. And with the interest rates high, these deductions puts cash back in your pockets and money you can reinvest into your business. The 18th benefit is the extra standard deduction for seniors. So what actually changed? Seniors 65 years and older get an extra standard deduction. So let's say you're a business owner and you are over age 65. So then you are allowed to take an extra $6,000 in standard deduction. And let's say if you're in a 24% tax bracket, this means that you will be able to save $1,440 in real money. And let's say now if you are married filing jointly, then you can deduct an extra $12,000. So that's an additional $2,880 in real tax savings. So why does it matter? Automatic savings for older taxpayers and no paperwork. The number 19 is the Medicare AGI brackets. So what actually changed? Higher income means higher Medicare premiums, but the new rules let you deduct more out of the pocket premiums. Let me give you an example. You make $250,000 a year and you may owe $3,000 more for the Medicare Part B, but the bigger deduction can help you bring your income down and avoid that bump. So why does it matter? Every dollar of the AGI counts, so take advantage of all these massive deductions. Plan smart and then plan before the year ends. And lastly, the 20th benefit, something new. It's a Trump accounts and scholarship credit. So what changed? New tax-free Trump accounts for education, housing, or child care. Plus, you can get a tax credit for donating to the scholarship groups. So let me give you an example. Let's say you decided to donate $5,000, and then you get a $5,000 tax credit, which cuts your tax bill dollar for dollar. So why it matters? Use your taxes to invest in kids' future instead of just giving it away to the IRS. In today's video, I have covered 20 real ways to keep your money working for you, not the government. Remember, this only works if you plan ahead. Most people wait for the tax season, but tax savings are won when you plan before the tax season. Like, subscribe, and comment below. Which of these strategies do you need help with this year? And also, grab my free tax guide in the description and let's protect your money together. I will see you in the next video. Smart money, smart moves, and remember that financial freedom is all in your hands.